Welcome to XRP Pro Ledger, and today we need to address something directly before we get into the data, because the most searched question on YouTube in the XRP space right now is, are banks skipping XRP? And the on-chain data from the last 5 days provides the most definitive answer to that question that this market has ever produced. Exchange balances have dropped 57% to a 7-year low of 1.5 billion tokens. In the last 20 hours alone, another 22.8 million XRP left centralized exchanges, pushing the 5-day cumulative supply vacuum to 217.8 million XRP. Zodia and Fireblocks, two of the most systemically significant institutional custody platforms in the world, are reporting a 12% increase in protocol-locked XRP, collateralizing institutional credit lines and removing those tokens from tradable supply permanently. Stay with this analysis until the end, because a Frankfurt-based investment bank's liquidity-adjusted model has calculated a structural price floor of exactly $4.82, and Standard Chartered has a $28 endgame target with a specific timeline. And the math behind both numbers will reframe everything you think you know about where this market is heading. Let us address the psychological environment that is producing the bank skipping XRP search volume, because understanding it is the first step to reading the data correctly. When retail investors see price consolidation, they look for an explanation. And the explanation that the loudest voices on YouTube are currently providing is that institutional adoption is slowing, that banks have evaluated XRP and decided to move in a different direction. That narrative is not supported by a single verifiable data point. It is supported by the absence of public announcements, which retail investors are interpreting as an absence of activity. The absence of public announcements is not evidence of institutional disengagement. It is the standard operating condition of institutional due diligence. Banks do not announce settlement infrastructure decisions before the legal compliance and technical integration frameworks are complete. The silence is the process. And the on-chain data running beneath that silence tells a completely different story from the one YouTube's loudest voices are currently constructing. The April 24th event provides the clearest possible evidence of what institutional accumulation looks like when it operates at full velocity. On that single day, 34.94 million XRP flowed out of centralized exchanges, with 94.4% of that volume routing directly to cold storage, not to trading wallets, not to OTC desks for immediate resale, to cold storage, the custody infrastructure that institutional balance sheet holders use for long-term asset vaulting. That single-day event, combined with the 22.8 million drained in the last 20 hours and the cumulative 217.8 million removed over 5 days, has produced a supply structure at exchange venues that is now triggering measurable market dysfunction. When Asian markets opened Monday morning, institutional automated trading systems experienced a 4-minute severe slippage event on Tier 1 exchanges because the liquid supply that those systems require to execute large orders without price impact has been systematically removed from the available float. Banks are not skipping XRP. Banks are removing it from the market at a velocity that is causing the market's own execution infrastructure to malfunction. The spot ETF data from Monday's open provides the demand-side confirmation that completes the supply compression picture. When Asian session institutional bots hit severe slippage on Tier 1 exchanges, the US ETF products absorbed the demand that the exchange order books could not service cleanly. Spot ETF limit buy orders hit record highs during Monday morning session, and total AUM across the 4 US-listed spot XRP ETFs reached $1.65 billion. That figure represents institutional capital that has entered the XRP market through regulated fund structures, capital that sits on balance sheets with quarterly mandates, managed by portfolio risk teams whose investment theses are not influenced by YouTube search volume. The combination of a 7-year exchange supply low, a 217.8 million token 5-day drain, a 4-minute Monday slippage event, and $1.65 billion in ETF AUM at record highs is not a picture of banks skipping XRP. It is a picture of an asset whose available public supply is being consumed faster than the market's execution infrastructure can process the demand. The swift development circulating in European banking circles this week provides the institutional context that explains why the accumulation pressure is accelerating rather than stabilizing. Internal memos from European bank operations teams are expressing significant frustration with Swift's new ISO 20022 update, citing settlement speeds and per-transaction costs that are incompatible with the efficiency requirements of high-volume cross-border flows. The specific performance comparison that is circulating in these internal documents is stark. XRPL-based settlement infrastructure is 127 times faster than SWIFT for USD SGD corridor transactions and 98% cheaper on a per-transaction cost basis. When European banks run those numbers against their current SWIFT infrastructure costs, the business case for migration is not a theoretical projection. It is a documented cost differential that is producing internal institutional pressure to accelerate the transition timeline. The banks that are accumulating XRP right now are not doing so because they find the asset conceptually interesting. They are doing so because their own internal cost modeling is generating a migration imperative. Vanguard's positioning represents perhaps the most significant institutional signal in this entire week's dataset, precisely because of the historical context it carries. Vanguard has been one of the most consistently and publicly skeptical major asset managers in the traditional finance space regarding digital asset investment products. Their institutional credibility in the traditional finance world is built in part on that skepticism, their reputation for disciplined, evidence-based asset allocation decisions. The emergence of a privately drafted digital wealth fund document listing XRP as a core settlement asset for high net worth clients is not a casual or experimental development from an institution with Vanguard's analytical culture. It is the output of an extended internal due diligence process that began long before the document was drafted, a process that concluded with the determination that XRP's settlement infrastructure represents a legitimate core holding for institutional wealth management portfolios. When Vanguard moves, it moves based on evidence. The evidence they found is the same evidence the on-chain data has been showing for weeks. The Golden Triangle development, the coordinated settlement infrastructure being built across Zurich, Dubai, and Singapore provides the geographic confirmation that the institutional XRP adoption thesis is not a US-centric regulatory story. It is a global settlement infrastructure story that is using US regulatory clarity as its legal anchor point while building operational corridors across three of the world's most significant financial centers simultaneously. Legal teams coordinating across those three jurisdictions have executed a live settlement test, moving $5 million between Zurich and Dubai in under 4 seconds using Ledger Bridge infrastructure. The Ripple-affiliated presence currently in Dubai's DFC Financial Center suggests that what has been described as a tripartite settlement agreement is in its final signing phase. A live $5 million test settlement at 4 seconds is not a proof of concept, it is a production validation. The agreement being signed in Dubai is not about whether the infrastructure works. The infrastructure has been demonstrated to work. The agreement is about who operates it, at what volume, and under which regulatory framework. David Schwartz's response to the NDA conspiracy theories circulating on social media deserves to be addressed with the analytical precision it warrants, because the conspiracy framing is producing genuine retail confusion about what NDAs actually represent in institutional commercial relationships. Schwartz stated directly that NDAs are standard business privacy instruments, the legal mechanism that allows two commercial entities to conduct detailed technical and commercial due diligence without either party disclosing the existence or substance of those discussions to competitors or the public market. An NDA does not indicate that something is being hidden from regulators or that the relationship is problematic. It indicates that the relationship is real, substantive, and at a stage of development where premature public disclosure would create commercial risk for both parties. The institutions operating under NDAs with Ripple are doing so because they are conducting real due diligence on real integration proposals, and the NDA is the standard instrument for protecting that process. The zero-knowledge proof development that Schwartz hinted at in relation to the upcoming sidechain bridge represents the technical breakthrough that resolves the final privacy objection that regulated financial institutions have maintained against public ledger settlement infrastructure. ZK proofs allow a bank to mathematically demonstrate that a settlement transaction is fully funded and complete without revealing the specific account balances, counterparty identities, or transaction amounts to any party outside the permission disclosure framework. For a regulated bank with client confidentiality obligations and competitive sensitivity around transaction flow data, the ability to settle on a public ledger while maintaining full cryptographic privacy over transaction specifics removes the last architectural objection to public XRPL deployment. The Clarity Act Section 6 Digital Commodity Safe Harbor removes the regulatory objection. The ZK proof sidechain removes the technical privacy objection. The two developments together eliminate the two remaining institutional barriers to public XRPL adoption simultaneously. The institutional DeFi momentum provides the ecosystem confirmation that capital is not waiting for the regulatory and technical frameworks to be fully finalized before deploying into XRPL infrastructure. A KYC whitelisted XRPL liquidity pool attracted $15.50 million in institutional deposits in just 6 hours, a capital deployment velocity that reflects institutional conviction operating on a defined timeline rather than open-ended speculation. Evernorth's planning to deploy the new native lending protocol XLS-66 for institutional yield generation adds a regulated corporate entity to the ecosystem adoption picture, a company operating inside the US regulated healthcare finance space, making infrastructure decisions based on the same cost-efficiency analysis that is driving the banking sector migration from SWIFT. The RLUSD supply crossing the $1.40 to $1.60 billion range and functioning as margin collateral across 280 OKX trading pairs creates a recurring, transaction-driven demand base for XRPL liquidity that operates independently of market sentiment cycles. The RLUSD Treasury collateralization mechanism is now generating $5.10 million per week in interest surplus, a figure that has increased from the $4.80 million weekly figure reported earlier this week as RLUSD issuance has expanded. That surplus capital is being deployed into zero-cost bridge trials for banking partners, effectively eliminating the financial barrier to entry for banks evaluating XRPL settlement infrastructure. When the cost of piloting a new settlement corridor is zero, the only remaining barriers are technical readiness and regulatory certainty. The ZK Proof sidechain addresses technical readiness, Section 6 addresses regulatory certainty, and the $5.10 million weekly war chest ensures that the financial incentive structure for banking migration remains in place for as long as the institutional onboarding process requires. The three elements, technical, regulatory, and financial, are converging simultaneously, which is precisely why the supply compression data is showing the accumulation velocity it is showing right now. The Frankfurt-based investment bank's liquidity-adjusted model produces the $4.82 structural floor through a framework that begins with a specific and verifiable input, $4.50 billion in projected daily institutional flow driven by RLUSD, scaling across the corridor infrastructure that is currently being built and tested. At that transaction volume processed through XRPL settlement infrastructure at the token's current circulating supply, the minimum XRP price required to service that volume without generating liquidity fractures that degrade settlement efficiency is $4.82. That is not a ceiling. It is not a target. It is the structural floor below which the infrastructure does not function for the use case it is being built to serve. Standard Chartered's revised target structure adds the demand-side projection to the supply-constrained floor calculation, $2.80 in the near term, scaling to $12.60 by 2028, reaching $28 by 2030, driven by the $4 to $8 billion in projected ETF inflows that the Bitwise demand confirmation and SEC acknowledgement have made statistically probable. The floor is $4.82 because that is what the infrastructure requires. The target is $28 because that is what the capital flows project. The distance between the current price and both numbers is the institutional front run that the on-chain data has been mapping all week. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.